This video contains affiliate links, and I earn a referral fee if you use the services mentioned at no extra cost to you, because they're the best in the industry. 3 things to consider before lending money to your S Corp detailed guide when you're running an S Corporation. There may be times when the business needs cash for payroll, inventory, expansion, or unexpected expenses. One option owners often consider is lending money to their own S Corp shareholder loans. But this isn't like handing cash to a friend. The IRS and accounting rules treat it very seriously. What is an S Corporation? Quick review: an S Corporation. S Corp is not a separate business entity type, but a tax status available to corporations, including LLCs, that elect S Corp status that allows profits and losses to pass through to the owner's personal tax returns, avoiding double taxation. This pass-through taxation means that S Corp owners report business income or losses on their personal returns, and basis in the company affects how much loss they can deduct. Step by step, what it means to lend money to your S Corp. Before we dive into the video, let me introduce you to Busy, a professional formation service company that specializes in helping you file your LLC or corporation. Busy is an amazing company that simplifies the entire process of creating your LLC. They even offer a service where they'll file your LLC on your behalf, saving you from all the hassle. A full review of Busy is available in the description box below. 1. Understand basis, why it matters. Basis is your investment value in the business for tax purposes, and it determines whether you can deduct losses on your personal tax return. How distributions money taken out of the company are taxed. What happens when selling your S Corp stock? There are 2 types of basis. 1. Stock basis, money you invested in the company, initial capital plus later contributions. 2. Debt basis, money you lend as a loan tip. Losses can only be deducted up to your total basis stock plus debt. If basis is too low, you can't deduct losses now. Instead, they carry forward to future years. 2. Decide loan versus capital contribution. When you put money into your S Corp, it can be one of 2 things. Type what it means: IRS treatment loan, the business owes you money back, debt, basis added. Must document properly, capital contribution, you increase owner equity, stock, basis added. No repayment obligation, why it matters. A loan can allow the company to repay you later. A capital contribution does not create a repayment obligation. Money becomes part of owner equity. Choosing incorrectly can lead to wrong tax treatment. 3. Avoid debt being misclassified as equity. The IRS checks whether your loan really looks like a loan or if it's effectively owner equity capital. If it's treated as equity, you lose the benefits of debt basis, and it could affect deductions and distributions. Key features of a true loan: written promissory note, fixed repayment schedule, reasonable interest rate, no repayment tied to profit, not subordinated behind other debt. This means the loan should resemble what a bank or outside lender would provide. Tax rules and documentation. What you absolutely must know: documentation is critical. The IRS reviews shareholder loans very closely. Without documentation, a formal written loan agreement, the IRS may treat repayments as ordinary income. Consider the loan as a distribution or equity contribution. Remove debt basis, affecting your ability to take losses. Example: if your loan is not in writing and less than $25,000, it could be open account debt and treated differently for tax purposes. If it's over $25,000, consider always documenting it to get the safer tax treatment. Repayment tax treatment, depending on documentation and basis. Properly documented loan gives repayment treated as a capital gain, no ordinary income. Unclear or undocumented loan gives repayment maybe ordinary income and taxed more heavily. That's why professionals emphasize formal loan documents. IRS 1 class of stock rule: an S Corp is allowed only 1 class of stock. If a loan creates a 2nd class of stock, for example, unfair rights or benefits, your S Corp status may be jeopardized, potentially causing serious tax issues. This is a technical area where a tax attorney or CPA can help you structure your loan correctly to stay compliant. Tips for structuring your shareholder loan: best practices. Here's a practical step-by-step list for lending money to your S Corp correctly. Determine loan amount. Only lend what the business truly needs. Draft a promissory note. Include repayment, schedule, and interest. Set a reasonable interest rate. Avoid IRS reclassification. Record corporate minutes. Document approval of the loan by the board. Keep strict accounting. List the loan on the company's books. Report interest income on your personal tax return. Track repayments carefully, principal versus interest. Consult professionals, CPA, tax attorney, before finalizing frequently asked questions, FAQ. Can I deduct the loan on my personal tax return? A. No. Loans are not deductible personally. It's a balance sheet item. You only recognize interest income when the company pays interest to you. Q. What if the company never repays me? A. If you can prove it was a legitimate loan and the company defaults, you might claim a bad debt deduction. But tax rules are complex. Proper documentation and professional advice are critical. MC. Should I lend money or just contribute capital A? It depends on your business goals. Loans allow repayment. Capital contributions increase equity, but don't require repayment. Think about tax and cash flow outcomes. Q. What happens if the IRS reclassifies my loan? It can be treated as a dividend or capital contribution, changing how you're taxed and possibly eliminating debt basis. Proper documentation helps reduce risk.